This course isn't meant to be an introduction to investing in general. It's more about an introduction to value growth investing and the method I use to make 20 to 30% return on my money year on year. Just to make sure that we're all on the same page though, I'll run through some basic investing concepts before moving on to value growth investing specifically. So investing is all about finding an asset that you can buy that you'll expect to grow over time. Remember, it's about making your money work for you instead of you working for money. Examples would include buying property and watching its value rise as you take in rent, or fine art that grows in value over time. You could also invest in gold or oil, or my preferred method, the stock market. In the stock market, basically what you're doing is buying a small share of a business that you think is doing well and is likely to do well in the future. If that's the case, then you could sell your shares and make a nice profit that hopefully is greater than inflation. Investing in the stock market has been shown to give the highest return over many years, and in my opinion is easier than investing in property or fine art with much less risk. An added benefit is that many stocks pay dividends that you can reinvest in the company to increase your returns even more. But there are alternatives to investing, including spending your money as you earn it, so that you have lots of possessions that usually lose value over time. Or you could save some money each month in a bank account, but you don't get much interest on your money, and inflation eats away at your savings year after year. Another possibility would be to put your money in bonds. This is like lending your money to a business or the government, for which you get a regular interest payment. But there's rarely any capital growth in the bond, and there's the real possibility that you wouldn't get your money back if the company got into trouble, especially if you buy bonds in lower grade companies. The next question to ask yourself is, should I be investing at all? It makes sense that you should only be investing your money if you actually have money to invest and aren't in debt. I mean, a mortgage and car loan are probably okay, but I'd pay any credit card debt off before I invested my money elsewhere. In fact, I'd probably pay the car loan off too, unless the interest rate on it was very low. You can also invest money in your retirement fund in some cases, and this would make sure that you have a nice pot of money to take you through retirement. Another question to ask yourself is, should I invest the money myself or give it to a financial advisor or fund manager? This is a question that I'm afraid only you can answer after you've got some financial education, or you've found a method of investing that you feel you can trust. But I would ask you this question: who would treat your money most carefully, you or a financial advisor? There's often a conflict of interest here. Advisors are wanting to maximise commissions and fees, and they often focus on frequent trading rather than buying and holding for the longer term. Individual investors want to minimise fees and increase the long-term returns on the money, so less frequent trading is probably best. If you're interested in learning more about investing, then I don't think you need an advisor. You can learn all you need to know yourself, or follow my method of value growth investing. You can even open a virtual portfolio to start with, so you aren't risking any of your own money as you learn the steps involved. So if you've decided that investing is for you, and you have a regular amount to invest, or a lump sum, what are the barriers you face when you get started? Well, first of all, there's knowledge, or rather lack of it. It can take years for you to gather the information you need to make sound investment decisions, unless you follow a proven method that you can trust to give you good returns with minimum risk. Next comes time, and have you got enough of it to spend learning all you need to know, and then doing all the research to find good companies? To do all this, you also need to have a strong interest and enthusiasm for investing, unless, again, you're following a trusted method. Finally, you may face uncertainty, especially if you listen to others who don't share your desire to earn good returns on your money, or who are worried about the unknowns of the stock market. So what are the benefits of investing on the stock market? First of all, the returns on your money have been shown to beat savings, property and other investments over the long term. The risk of loss can also be minimised by doing good research on companies and by setting the price that you'll sell at if the stock doesn't perform as expected. Your money is also liquid in the stock market, and this means that you can always get hold of it and you don't need to wait to sell a property, for example. Investing in the stock market can also be an interesting pastime, at least for me. I enjoy researching good companies and reading their financial reports. This may not be for you though, so I've put together a step-by-step approach that enables you to reach an investment decision without the painful and stressful analysis of all the numbers. Finally, you have the security of knowing that your money is invested in solid companies that aren't likely to go out of business anytime soon. Let's now look at some of the pitfalls that can arise once you've actually invested your money in the stock market. First of all, it's important to have a plan before you actually make your first investment, so that you're not constantly second-guessing yourself or listening to the news or other people when making your investment decisions. It may be helpful to invest with pretend money first, until you've the confidence to invest real money and not get unsettled by the ups and downs of the stock market. Having a clear understanding of what your investing goals are is important, and it'll help you to stick to your strategy. Also, don't invest with borrowed money, or money that you may need soon. And try not to focus on the short term. Instead, take a longer term view, and over time the returns on your investment will come. Unfortunately, growing your wealth does take time, and there's no shortcut. And frequent trading leads to higher transaction costs that will impact on your returns. So make less frequent, larger investments rather than frequent, small ones. Finally, avoiding losses is really important, so make sure that you've done your research and you're clear about when you need to sell your investments. Once you've made the decision to invest your money, it's important to look at the different types of investing. And it's also important to have a plan or strategy that covers all 7 pillars of investing. Value growth investing is one method, and this has given me high returns with relatively low risk over many years and allowed me to retire to Australia at the age of 50. So let's take a closer look at value growth investing and see what it involves.